Hi, good evening. I'm Tony. I'm your instructor. And I thought I'd try to see if I can be of help, of more help than simply writing announcements or talking about certain issues just by writing. Um, I tried today to see if I could put together a way for us to communicate in a little bit of a better way and for me to get you some videos. And it took me a little bit to find the right program and so on. But I think I finally got it, and I'm using a program called Zoom. And it allows me to share, as you can see, share the PowerPoint slides with you and record at the same time. So this is a good thing. Basically, as I read your post, as I talked about in the document I have in the discussion, and I hope you had some time to read, and it gives you a little, or gave you a little bit of an understanding of where we're coming from and where finance fits in the scheme of things. Most of you are familiar with accounting, and so your view of the world is kind of an accounting-based view, and that's not bad. Accounting, of course, is recording and reporting, and but reporting what, or what are the requirements? Why do we want these things to be reported? Well, we have to back up a little bit because we have, when we deal with a company, we deal with mission, vision, and long-term objectives, and these things translate to strategies. And as part of the implementation, we have finance, we have human resource, and so on. This is how the organization works, is we put all these things together, and so we know how many people we have to hire, we know what kind of budget we have, we know what we're expecting in terms of revenues and cash flows and so on. They're all driven by strategies which are formed to implement long-term objectives. And accounting is merely a way for us then to report what has been happening. And we have a way of understanding whether or not we're successful because we have some objectives which were set by strategy and long-term objectives. And so we have something to compare and to measure whether we're doing a good job and so on. And so finance is kind of the driver, and accounting reports and gives us an idea of what's been happening. So I wanted to make sure that I can write something for you, and hopefully it's a little bit, clearer for you than it was before. As you go forward, many of you are trying to switch careers from accounting to finance. You're going to find that your job is quite different when you get into finance versus accounting. Well, look, let me just take a little time to talk a little bit about Chapter 1. There are just a few things I want to talk about, so I don't want to cover everything in the chapter, but if you have any questions, perhaps you can let me know and then we can talk about it. Basically, the idea here is they're going to talk about forms of business organization and maximization of wealth, determinant of values, and so on. I think that, they're talking about financial markets and so on. These things you can read. The two things that I'm interested in that I think I should talk a little bit about is maximization of wealth and determinants of fundamental value. So please excuse me there. So let's go on. I'll skip, form organization forms, the various forms of business organization in the United States. These are the ones that we have. I'm quite aware that it's a little bit different in foreign countries. More specifically, and on the British side of things, we have a very different way of looking at things. And if you go and work in Vietnam, as I have, then you come up with an even more different forms of business organization. They have the same concept. They have the idea of a private company, and then a private corporation, and then maybe a publicly listed company, and so on. So they have these things. Becoming a publicly listed company, of course, you have to go IPO, and they tell you a lot of things. You can go to a company's website and find the what is called the red herring. They call it. They have different names, but generally, that's the floating document. And every company that is about to go public must have one of those. And they keep them on the website, no matter how long the company has been a publicly listed company. They have that as a part of the historical record of the company. And you can actually go and download it and take a look at it and see what happened when this company went public. One thing here that we need to just kind of mention, that the agency problem is all over the place. And this is when shareholders, not shareholders, I'm sorry, but the CEO and the management team, run the company in their best interest or not in the best interest of the shareholders. We have this group of people that's called the board of directors, and these guys are supposed to be standing in between the shareholders and the CEO, and they're supposed to be watching out for the interest of the shareholders. It doesn't always happen that way, and sometimes they don't know what they're doing and what is right for this organization, and that's when you have the wrong people on the board. And the managers still get away with doing things that are in their best interest rather than the interest of the shareholders. Generally, we'll lump these kinds of decisions into what we call the agency problem. And so basically, this generally doesn't create value for shareholders. It creates value and may even create problems in society and so on. But it generally creates value for the people who make them money or get value from all of this would be either the CEO or the management team, as you have seen in Enron, and the shareholders are left holding the bag. So this is a very serious issue, and we have to pay attention to it. And even as we move into what should be the unifying principle, or the objective of the organization or corporate finance, it is really the maximization of the value of the firm. And generally, this boils down to maximization of shareholder value, which can be further reduced to maximization of the price of the stock. How does this happen? How do we create value, and how do we value the company? How do we value the share price of the company? Well, it's about cash flows. It's not about revenues, because there are many conflicts with revenues, and there are many ways in which these things can be manipulated, and so on. So no matter how it is manipulated in the end, when we look at cash flow, whether they make bad decisions or they do things with sales or inventory to make themselves look a little bit better, they can't fool the cash flow. So the cash flow is, in the end, what we use to value the company. Cash flows then are the result of revenues, the result of taking on good or valuable capital budgeting projects, which generate reasonable cash flow. We'll talk about what reasonable means, and in the end, create value for the firm, which creates value for equity or shareholders. And when you divide those things by the price of the stock, you get, of course, shareholder wealth or shareholder value. So the basic objective would be shareholder wealth, maximization of wealth of the firm, which results in shareholder wealth or equity. And of course, debt holders don't participate in the growth of the company, they get paid. The owners will participate in the growth of the company and the creation of wealth. Okay. And of course, you always have the idea that the negative part of it, which is that managers, if left alone, might make decisions and do things which are in their best interest or the way they see things, but generally in their best interest and not the best interest of the shareholders. Okay, so the agency problem, you come face to face with that. So it says, is maximization price good? Well, it is the generally what we have to do, and it is good. And if, generally people try to put their money where they can get the best return given the risk. They get paid for the risk and they get the best return. We'll learn about risk and return under capital asset pricing model, or CAPM as we call it, later on as we go forward. But nobody wants to put their money in some securities, where they're making a return of 3% when they could get 5% elsewhere. Money always try to go to the point where they're getting the highest return on their investment, given their appetite for risks and so on. So we want to make sure that whatever we're getting for the shareholders, actually they get is sufficient to pay them for the risk or the alternative use of their money. So in general, we want to put people put the money where they think they can get the most return for their investment. And it is incumbent on the managers to take on projects that create value. We'll talk about what value creation really means. So to create value for the shareholders. Okay. So it is a good thing, and managers have to try and maximize shareholder wealth, or the guys are going to take their money and go where they can get the best value. All right, they talk about what aspects of cash flow affect investment value. The amount of expected cash is very important. You notice it doesn't say revenue, it says cash. Timing of the cash flow is important. Why? Because today's money has the greatest value. A year from now, if we get $1, we have to discount it today to find the current value. And 30 years from now, it's going to be really much smaller because we're discounting those things at or cost of capital, and we'll talk a little bit about that later on. So the timing of the cash flow, this is the idea that we discussed, the concept that we discussed in time value of money. This is why I said to you, this is a very, very important thing, because it's used in almost everything we do in finance. And of course, risk. Risk, we must get paid for risk. And this shows up in the form of an increase in our expected return, or what we get paid for this investment. So in equity, it's the expected rate of return. It factors in market premium as well as risk factors, which is measured or inserted in this computation as the beta of the company. In terms of taking on debt or a bond, the bondholder factors the risk of this company, risk of default, and so on. And they add a percentage to their return. So when they say we're going to issue the bond and the bond is paying 8%, well, they're getting paid for a risk. These are not random values. And this company may have certain additional risks and so on. So all these things go into these computation, and we take these numbers, we compute out the cost of capital, or sometimes called the weighted average cost of capital, and we discount our cash flow going out into the future, whether it's 5 years or 10 years on a project, or infinity for the life of the company, whatever, we discounted at these rates. So it factors in all of the risk and so on. And then we value the company. So we use cash flows for these kinds of things. And typically we call this free cash flow. There are two types of free cash flow. One is to the firm, free cash flow to the firm, FCFF, and free cash flow to equity, FCFE. And so because why we have to value equity and we have to value the firm. And the difference between the two is that when we're valuing equity, we must take out the value of the interest. We must pay the interest on debt. And so once the debt holders get paid, whatever is left goes to equity. And so we can value the equity of the company and also the price of the stock. All right, so that's a bit about free cash flow and why we use them. And so the computation that you're going to see is, free cash flow. But generally, when we have done this project in the past, we looked at Home Depot and we took one point in time when we went forward using the income statement, and we used a 5-step process to figure out what the cash flow is going to look like. And then we use that to value the company. Now, so we go through another PowerPoint slide. We'll talk about terminal value and the value of how we figure out the value of the company and what the growth rates and stuff like that really mean. What is the weighted average cost of capital here? Well, we can figure out the cost of equity and the cost of debt. And once we do that, we kind of factored the percentage of debt and the percentage of equity multiplied by the cost of capital. And when we add these things together, we come up with the weighted average cost of capital. We'll show you later on how we come up with those things. But discounting and creating value is shown in this formula here, where we see the various cash flows and the weighted average cost of capital discounted to the present. And the ones and twos are just the year, and you see the symbol there for infinity. And we'll talk a little bit about how we do that, what that really means. Okay. And when we add all these things back to the present, we get what is called the intrinsic or fundamental value of the firm. Now, this is a very helpful picture, and we will be seeing this, excuse me, as we go along. But right now, it shows you that we have a step process, and we'll cover this in chapter 2, where we can come up with the free cash flow. We have a way of discounting free cash flow, which gives us the value of the firm. And below that, we see how we compute weighted average cost of capital. And so this is a very, very valuable picture. Now, this part, we don't want to waste time. This is how money flows around in a country like the United States, not the same for all countries. But in the US, this is the way money moves around. Cost of money, there are many different reasons why they factor all these things, and they come up with an interest rate. So when I go to the bank and I put my money in a savings account, they have a way of giving me some return, which factors in all of these kinds of things: time preference for consumption, risk, expected inflation, and so on, are all factored in there. And I come out with some interest rate. And that's the cost of money. That's what I get paid. Now the company, the bank might invest in something else, a bit more risky projects. They get a higher value. The difference between the two is what their profit is, assuming that everything works out. What economic conditions affect the cost of money? Well, we have many other things: budget deficits, Federal Reserve, monetary policy, fiscal policies, and so on. These things all are factored in. Interest rates, the basic interest rate, as you hear about today. Financial securities are many. Later on, we'll talk about derivatives, options, and futures. For today, we talk about stock prices, we talk about bond and T-bills, and so on. These are the more important. Financial institutions, all right. Markets, I mean, if we have capital and financial markets and how they work and so on, we're not going to spend too much time with that. You can read a little bit about that. You probably know enough about it at this point. Here they talk about this thing called the S&L. And if you, well, most of you guys are not that old, but in the 80s, we had this financial crisis. So the one you saw in 2006, 2007, you think that was the only one. Well, it's not the only one. It's we had this similar thing called the S&L crisis in the 80s, where we had a meltdown and created a big problem for the banking system in the United States. And in 2007, we had a similar thing. These are called bubbles. And every time they happen, we create a whole bunch of regulations, and we say, "Oh, that will solve the problem." It will never solve the problem, because this revolves around behavioral finance, how people behave in investments, and in particular how they behave in the stock market and in the real estate market. These investments have a very peculiar behavioral type of issue around them, and that is that in general, if the price of an asset goes up and departs very far, start from the fundamental value, generally people know and people don't buy. And so if I'm selling you a car and the car is worth, generally you figure the car is worth $10,000 or $15,000, but I'm asking $30,000 for it, you're just going to walk away. I'm crazy and I'm not trying to cheat you or something like that. But you understand fundamental values, and you understand that you're not going to pay more than what the value of the asset would be. It's very, very different in finance and real estate. And that is, the more the value of the asset departs from its fundamental value, the more people want to get into to buy that asset. And that seems very silly, but it's the way it is, because you see the stock price going up or the housing market going crazy, and people think, oh, gee, this guy's making a lot of money, so maybe it's time for me to get in and make some money also. Excuse me. And so people go into the market, and the bubble, this creates the bubble. This is fundamentally how the bubbles are created, and the bubbles continue to feed on themselves. And eventually somebody figures out, wait a minute, this is not right. We're too far away from the value. And before long, people start to sell, the bubble bursts, and people lose a lot of money. Now, this is not a phenomena of the 80s or a phenomena of the last few years. Bubbles have always been around in this way. And one of the most memorable is the Dutch tulip bubble. And you can read a little bit about this. It's kind of interesting and funny, but people were selling their homes and their farms to buy a single bulb, a single tulip bulb. And when the bubble burst, they lost many things. The South Sea bubble was also a big one. These things go back to the 15th and 16th century. And so you see, bubbles have been around, and bubbles will always be around. And there is no amount of regulations that we can come up with that will stop it, because we have people involved, and people behave a certain way in finance, a certain way when money is around like that. And so the S&L happened, and 2007 happened. I have a video. I made a set of PowerPoint slides, having done some research on this matter. And I have them, and I can send them to you, and you can take a look and you read them and see what you think. So bubbles, very important part of finance. And in fact, bubbles happen every day in the financial markets, but they're not allowed to depart. And bubble is an essential part of growth. If you look how the stock market works, and you will see that maybe 3 or 4 trading sessions, or maybe a week, the market will continue to go up when it hits the top, and then people realize, oh, it's kind of like departing from its fundamental value. They begin to sell, and it comes back down to its fundamental value. And then it does the same thing, but hopefully when it comes down, it doesn't go below the low of the last session. And so generally when you draw the line is up. There's a straight line uptrend. And so it's essential that miniature bubbles are created regularly in the stock market, and it happens to be the way growth is taking place. But if it gets into a problem when it departs radically from the value, from the basic fundamental value of the asset, and that real bubble, and when it bursts, many people get hit. Okay, well, securitization is a way that we take these debt obligations and we wrap them up into securities, and we sell them as a security, and there are people who buy them, and people at the other end have to pay, and so they get a cash flow and a stream of cash from these securities, and the securities are generally guaranteed by somebody in the system. Sometimes it's an insurance company, as in the case of 2007, it was AIG. If and when the bubble burst and companies like AIG just simply take on too much, and when the bubble bursts, they can't support the loss, then everybody goes bankrupt. Everybody loses. The banks lose. The people who buy the securities, the insurance companies, they all lose, which is what you saw in 2007, 2008 timeframe. And generally these things, they call it subprime, and to some extent, some of that is to blame. But really, if you think about it, it's not people who own a single home and barely struggling to keep that home. Generally, it's the speculators and the rich guys and the people who were buying up lots of properties and leverage on something else, a previous property, and in the end, they just couldn't pay it. And so they just walked away from it. So while they call it the subprime problem, and to some extent that it was responsible, it's the bulk of the problem wasn't really the poor guy who was trying to hold on to a home for his family and so on. That's not where the problem was. But you can read a little bit more about these things. All right, that ends this chapter. I'm going to give you this video. I'm going to try to upload it to YouTube tonight. And then I'm going to try to make 1 or 2 more. Okay? All right. Take care. And hopefully you enjoy it and it has some value to you. All right. Good night.